We have completed writing the introduction. Let's revise it once. Accounting for investment. What does accounting for investment mean? Investments can be classified. Firstly, we should understand how investments are classified. Investments are classified into real investment or financial investment. Real investment are those investment which bring real assets into existence. Example, property and machineries, etc. Okay. Financial investments are those investment which does not brings any real assets into existence. So this is the important thing. We'll be dealing in this chapter, accounting for investment, only with financial investments. Okay, will not be dealing with real investment, as I earlier told you, because this chapter will be dealing with only shares and debentures. That's it. We have to calculate how shares are coming, how shares are going. We have to calculate the interest on the debentures and other dividend income and all, how to show it in the books of account. We'll be learning in this chapter. Okay, so financial investments are those investments which does not bring any real assets into existence. Example, shares, debentures, etc. These are known as securities. Shares and debentures are known as securities. Securities further can be classified as fixed income bearing securities and fluctuating income bearing securities. So what does fixed income bearing securities means and what does fluctuating income bearing securities means, we'll be learning now. So let's start with fixed income bearing securities. Wait a second. Okay. Fixed income bearing securities. Fixed income bearing securities. Here the rate of income slash, I write in bracket, interest and the date of income is always fixed. Okay. Example, debentures, bonds, etc. I hope you understood what does fixed income bearing securities means. Fixed income bearing securities are the securities whose rate of income, that is the interest, and the date of receiving such income is always fixed, because while taking debentures it is already fixed in advance that the interest will be given on this and this date. There are interest given twice in a year. Okay, the gap between the interest is 6 months. Okay, so we have understood now fixed income bearing security. We need to understand what does fluctuating income bearing securities means. Fluctuating income bearing securities. Fluctuating income bearing securities. Here neither the rate nor the date of income is fixed. Example, shares. The shareholders receive dividend. They do not receive interest, they receive dividend. So dividend is declared in the AGM, that is annual general meeting. As per, and the rate of giving dividend is decided in the annual general meeting. So not the rate nor the date of income is fixed. So we'll study this fluctuating income bearing securities in the later half. In the first half we'll be studying fixed income bearing securities. Okay, we'll be solving sums related to fixed income bearing securities. Not yet the theory has completed. Firstly, I'll want you all to please copy fixed income bearing securities and fluctuating income bearing securities. I hope you all have copied till here. Before starting to the next theory part, I just want to give you a format of how we'll be doing this chapter, a ledger format, how to solve the sums. Wait, I'll draw it for you. Five columns on the debit side, 5 columns on the credit side. So let's name the column first. Date, investment account. Investment account means you have to write the name, like if it is 12% debenture, 12% debenture, then you have to write in place of investment 12% debenture. If you have purchased securities, that is shares you have purchased from ABC Limited, the shares of ABC Limited account. Okay, and since it is a ledger, a most important thing that you have to present is write debit and credit. Three things that you have to write in this is debit, investment account, the specific investment that you have made, whether in debentures or shares, and the credit. Even if you don't write date, particulars, it's okay, but here I am, whatever here I am writing in these columns, you have to write that. Okay, I will be giving you particulars, then face value. FV stands for face value, income, and third column stands for cost. Again, date, particulars. Date and particulars, if you don't write, it's okay. Even if you merge the both the columns, even it is fine, because it looks little bit shabby, but it's okay if you merge the both columns, that is date and particulars. FV, income, cost. Okay, so firstly please copy this account, draw the account, because many a times students don't know how to draw the account, and they know entire chapter but don't know how to draw accounts. Great people. I hope you all have copied this much. Now we'll see study price quotation. What does price quotation means? I'll explain you in just a second. The last part of the theory for the first half. Price quotation. See, firstly I need to explain you before starting it. Price quotation, it is divided into two parts. Let me draw a chart. The first is X interest, and this is cum interest. Many of you all might be knowing this X interest and cum interest, X interest price and cum interest price, but many of you all don't know the full form of this. It is excluding interest price of security, and this is cumulative interest price of security. As the name says, we'll understand. It is quite self-explanatory, but many of the time students are confused between X interest price and cum interest price. They don't understand what is that. Price, the X interest price, what does this mean? X interest price means when you are purchasing the securities are divided into two parts. As you can see the column, it is divided into income and cost. So what does cost means and what does income means? Cost means the capital expenditure that you have done for purchasing the investment. So that is the cost. And what does income column means? Income column means the amount that you have paid for purchasing such securities. You will not understand it right now, you will not get a grip, but when we are solving the sums, please rewind back and listen to this part again. Okay, please note down the timing of the video so that you can come back and listen it again. Okay, so it is divided into two parts. First is the cost, the capital expenditure, and other is the income, that is the revenue income. This is the debit side is the revenue expenditure and cost is the capital expenditure. On the credit side, income is the revenue income and cost is the capital income. Okay, how will incur this? On the credit side, when you will do sales, you will income capital income. On the debit side, when you will purchase, you will incur capital expenditure. Okay, so let's move ahead. We'll write a small theory so that before starting you can read it. Wait. When the accrued interest till the date of purchase is paid separately, it is called as X interest price. So now you are understanding what does excluding interest price means. Now we'll understand the second part. When the accrued interest till the date of purchase is paid cumulatively with the price of purchase, it is called as cum interest price. Okay, what I told over here, the bifurcation of the cost and income, I'll give in writing so that when you come back and listen it, you'll get a better understanding because it is in a written format. Accrued interest is the revenue expenditure and should be recorded in income column, and cost is the capital expenditure and should be recorded in the cost column. Okay, and vice versa for the credit side. So firstly I want you all to please copy this much. I hope you all have copied till here. Please copy the remaining part. Hope you have done it.